Hello traders, in this video we are going to be taking a look at the envelopes indicator. This is a free indicator that you can find on most trading platforms. It basically consists of an upper envelope and a lower envelope, and what it shows you on the chart is if price is either in consolidation. Consolidation is when price is between the upper and the lower envelope, or if price is trending, which is when it is either below the lower envelope as you see here, or above the upper envelope as you see there. So this is a really simple indicator to understand. It can be used in both trending and ranging markets. So what you're looking for is price to break out from either the lower or the upper band. Okay, and when price does that, you can either enter on the breakout. For example, here there was a breakout of the lower envelope. You could have took a short trade, which would have been a really good trade. As you can see from that breakout of the lower envelope to where price is at now is around 180 pips. This is a 1 hour euro dollar chart. Okay, so you can either trade the breakout of the envelopes or you can trade a reversal. So with a reversal, what you're still looking for price to go either below or above the envelope, the lower or upper envelope, and what you're going to do is trade in the opposite direction. So for example, here, if you were trading reversals of the envelope, when price was to break out, you would have taken a sell trade. And to be honest, this is not a good example because you would have had to have had a stop loss around 30 plus pips, which is not ideal. You probably would have been stopped out on this trade, especially if you were going to place your stop loss around recent resistance here. You would have been taken out for around 10 pips. Okay, but that's why it's important not just to rely on one indicator or one method of analysis. You want to include price action, support and resistance levels, candlestick patterns, and of course always have sensible money management. Okay, so if we look at this example of trading in reversal based on the envelopes, and you were to enter long when price went below the lower envelope, this would have been a good trade had you placed your stop loss around this support level here, 20 pips. You can see the price went up over 50 pips. You could have taken an exit on the opposite envelope as well, or you could have been looking at this, say this resistance level here, had you taken a long trade reversal there and exited around that recent level of resistance there, still would have been 50 pips. A decent trade there. Okay, so as you can see, there's various ways to interpret the envelopes indicator, whether that's reversals or breakouts. As you can see here, the market is in a substantial downtrend. There was ample opportunities to enter trades based on the envelopes indicator. I mean, the important thing I feel personally when using this indicator is to look at the overall bigger picture and just to decide to take trades in direction of the trend. So we can see around this point here, after this drop, it was clear that we're in a downtrend the envelopes are heading in a downwards direction. I mean, if we put a moving average with the same period as the envelopes on the chart, you can see that it's bang in the middle of the upper and lower envelope. And some people actually would use this as an exit point or a time to move your stop loss to break even, or as a trailing stop. If we go back to this trade example here, if we were to enter long there and price moved up to here, we could have placed our stop loss and trailed it up using the middle envelope. The thing about in this example, okay, price did turn around, but there'll be other examples like here where that would have been a decent place to use a trailing stop or to look to exit the trade. Okay, so let's just remove that moving average and then look at, if we were here watching this unfold and we were considering a short entry on this downtrend, we can look for support and resistance. I think that's the minimal you should be doing in terms of price action, regardless of the indicator that you're using. So we'll mark off the support level there. You can see there's some indecision in the market. The bulls and the bears are fighting around here, and we do reach this level of support here, has become resistance around here, which is another bearish indication, along with, as we said, the envelopes going downwards, downtrend. So we could have looked for price, we could have looked to enter when price broke through this support level here, or had extra confirmation from the envelopes indicator when price broke through not only the support level but the lower envelope as well. So this would have been good confirmation for the trade. Had we taken it on the breakout of the lower envelope, we could have placed the stop loss just above this support level, which is 10 pips, which is a relatively tight stop loss on the 1 hour chart time frame. As we can see, price went over 100, well, it's still going over 100 plus pips, which gives an excellent risk to reward ratio. You could have used the moving average as a trailing stop or exit point, or the upper envelope. Okay, you would have got taken out prematurely, arguably around here. However, you could have closed out just a portion of the trade, moved the rest to either break even or put the stop loss around here somewhere just to lock in some more profit and just allow the rest of the trade to run. Okay, so that's an example of using the envelopes indicator in a downtrend. You can of course confirm your entry with additional indicators. Let's, for example, put the stochastic oscillator on the chart. Okay, if you're not familiar with this stochastic oscillator, this indicator here, basically it has an overbought zone, which is this zone here, anything above 80, and a oversold zone, which is here, which is anything below 20. And what you're looking for is this main line to be above the signal line for an uptrend or below the signal line for a downtrend. Most traders will look for a cross of these lines near or in the extreme overbought or extreme oversold areas to signal a change of trend direction. So in this example that we're looking at, we're looking for price to be in or around the overbought zone to suggest, okay, we're expecting a reversal to the downside soon, and that happened here. Okay, so I mean, there are traders who would have taken a trade based on that stochastic alone. However, if you want to use the envelopes indicator, I mean, that would have been good confirmation of the trade, although perhaps the envelopes were lagging in this instance, whereas the stochastic would have got you up around here somewhere. The envelopes breakout happened around 20 pips later, but there will be instances where maybe the stochastic will suggest, okay, price is showing you that price is heading in one direction, but the envelopes doesn't necessarily agree. There's a perfect example there. Well, that would have actually been a really good stochastic based trade. Again, perhaps that just emphasizes the point that the envelopes indicator can be lagging. But there will be instances when using a combination of indicators will prevent you from taking trades that you may have otherwise have taken with just the one. And always look at price action as well. I mean, the crossover of the stochastics here, you know, would not have been an ideal entry point, and the envelopes would have backed that up as price wasn't on the other side of the lower envelope. Okay. But you can see there's multiple examples to use the stochastic. So that's the one there. You could have used it crossover around here. However, you're not that close to the overbought zone. We are above the 50 line, which is still considered, you know, an area where you'd want to look for crossovers. But then again, the price action, you could have just waited for this level of resistance to build up again. You see some indecision with these bars. You have doji bar there. And yeah, you know, you could have been looking to sell based on the price action there. Again, a breakthrough here of the lower envelope. I mean, that would have been a decent entry there to get in. Probably you would have been later to the move than had we entered on this initial point around here. Yet there's still plenty left in the tank to take this entry there. As you can see, the stochastic is showing the main line below the signal line. However, it's not in the overbought zone, which just goes to show that indicators are not always reliable, which is why it's imperative to also have an eye on the support and resistance levels to confirm your entries. But the stochastic did give us a nice crossover entry near the overbought zone there, despite the envelopes not agreeing. However, here you could have taken a trade based on the breakout of the lower envelope there. Okay, so